Okay, I know that a previous document on Canvas referred to a discussion of the use of a separate accumulated depreciation account by saying one more time, implying that was the last I was going to mention it. However, I think it's, looking at the work that people are doing and some of the confusion that's been arising, I think it's important that we do this yet again, one more time. So let's go ahead, and this isn't an asset sale or anything, this is just simply elimination entries when the subsidiary uses a separate accumulated depreciation account. So let's assume that on January 1st, 2020, Big acquired 80% of Little. All of Little's assets and liabilities had fair values equal to book value except for equipment, which was undervalued by $10,000. The equipment had an 8-year remaining useful life at that time. At acquisition, there was also $10,000 of goodwill. So the total differential was $20,000, $10,000 of which was ascribed to undervalued equipment, the balance of which was ascribed to goodwill. And Little had accumulated depreciation of $30,000 at the date of acquisition. On January 1st, 2024, so several years later, Little had owner's equity of $400,000, comprised of $100,000 of common stock and $300,000 of retained earnings. 2024 reported earnings were $80,000, while dividends of $30,000 were paid. And the requirement is to prepare elimination entries for 2024. Okay, part of this is easy, part of this is not. Now, as I mentioned in some of the other class notes, we have two ways we can deal with that separate accumulated depreciation. First, let's go ahead and do this in what I think is the simpler way. We'll do our S entry. We eliminate the subsidiaries beginning of your equity accounts. So common stock, 100,000, retained earnings, 300,000. We'll go ahead and record the goodwill, and we'll go ahead and record that that differential related to the equipment. Okay, now that $10,000 of equipment differential, that was back on January 1st, 2020. That $10,000 differential was being written off over 8 years at the rate of $1,250 per year. So they've already taken depreciation for 2020, 2021, 2022, 2023. So they've already got, in the past, 4 years of depreciation on this thing at $1,250 per year. And so they would be carrying forward $5,000 of accumulated depreciation. And again, that's just the accumulated depreciation from the annual amortization entry. This total, what have we got? That plus that plus that plus that minus that. This total of $415,000 is going to be split 80% to the investment, $332. The other 80% to the non-controlling interest. Okay. As a separate entry, we can get rid of the accumulated depreciation at the date of acquisition. So at the date of acquisition, there was $30,000 of accumulated depreciation, and so we're going to eliminate that. Again, to me, this is the easiest way to do this because we've got two things going on with our accumulated depreciation. We have our original accumulated depreciation that we're writing off in a recurring entry, but we've also got the accumulated depreciation that is sort of being carried forward as the cumulative adjustment from writing off that property, plant, and equipment differential. In any event, if I delete that, that's going to go. There we go. We can go ahead and continue on. We do our amortization. Another $1,250. We go ahead and record our investment income elimination. Now, this is one where we should be getting fairly adept at doing this. Basically, the parent's investment income is going to be their share, 80%, times the subsidiary's adjusted / realized earnings. So we're going to start with a reported earnings of 80,000, and then we say, look, because of this amortization, we're adding a $12.50 debit to the income statement. That reduces income by $12.50. So the parent's investment income is going to be their share of the adjusted earnings, or $63,000. If you had done the equity method entries separately, then that $63,000 should simply be the sum of your equity method entries for income and amortization. Dividends we split in the usual fashion. There's a total of $30,000 in dividends, 80% of which is going to go to the parent's investment. The other 20%, or $6,000 of which, is going to go to the non-controlling interest. And we close out the dividends declared. Okay, last, the income to the non-controlling shareholders. Again, this should be the non-controlling shareholders' ownership or claim, 20% of the subsidiary's adjusted / realized earnings. We start with the reported earnings of $80,000, and we increase that or decrease that in line with the previous elimination entries. And the only one of these elimination entries up here that affects the earnings from the subsidiary is this debit to depreciation expense of $12.50. So that reduces, whoops, that reduces the income to the non-controlling interest. Okay, now, as I mentioned, this is the way of dealing with the separate accumulated depreciation, which is easier for me to grasp. Basically, we view the elimination of the date of acquisition, accumulated depreciation, as an identical recurring entry occurring every year for as long as the subsidiary owns that equipment. If you wanted to roll those two entries together, that's perfectly fine. It's just not quite as intuitively pleasing. Again, we'd eliminate the subsidiaries beginning of your equity accounts, common stock, and retained earnings. We carry forward the goodwill. Now for the equipment and the accumulated depreciation, though, think back to what happened way back when on the date of acquisition. On the date of acquisition, we wanted to eliminate the accumulated depreciation of $30,000, and yet at the same time we wanted to write up the net asset by $10,000. So if you get a $30,000 reduction in a contra asset, if you're reducing the contra asset increases the asset, right? So if you're reducing the contra asset by $30,000, that's going to increase the asset value by $30,000. You only want it increased by $10,000. So you're going to have to go ahead and credit equipment for $20,000. Now, as far as the accumulated depreciation is concerned, again, back on the date of acquisition, you would have eliminated $30,000 of accumulated depreciation, but you've got these recurring A for amortization entries. So you would have done this in 2020, 2021, 2022, and 2023. And so although you would have initially debited accumulated depreciation for $30,000, you've credited it for $5,000 over the previous 4 years. So what you're carrying forward for accumulated depreciation is only $25,000. Now, I hesitate to say clearly, but clearly this entry is the same as these entries netted together. And we see here a net debit to accumulated depreciation for $25,000, and what have we got? We got a $5,000 credit, $30,000 debit. That's a net debit of $25,000. For the equipment account, we had a $10,000 debit a $30,000 credit, that's a net credit of $20,000. So again, we're getting to the same place. It's just a question of how you like to sort of structure your work. In any event, the investment in little, same as it was last time. They're going to get their 80% of this plus this plus this plus this minus this. Same 332 as it was over here. Likewise, the non-controlling interest would be the same as well. So again, whether you choose to deal with the separate accumulated depreciation account as a separate elimination entry, or whether you choose to roll it into this one, either way you get to the same place. This one's easier because we simply have this recurring entry over and over and over again every year. And up here, all we're doing is dealing with carrying forward the cumulative effect of the previous 4 years' credits to accumulated depreciation.